You right now watching this video, by the end of it, you're going to have my strategy that I use to make $7,000 on one Forex trade. It's a very simple strategy, but you need to make sure you actually watch the entire video so you don't miss any particular step of the plan in order for you to actually get these type of results. So watch until the end, take notes. This is one of the most powerful strategies out there that I've seen. You're very lucky if you clicked on this video, start applying it, and you're probably gonna see results very, very soon. Let's get straight into this strategy right here and into the charts. All right, so let's get into it. So first of all, we're gonna start off always on the higher time frames to get an idea of where the market is going. So here we're gonna go on the weekly time frame, and if I just hide all of these drawings right now, we'll see where has the past 4 weekly candles have been. We've all been going bearish. So that's a very clear sign that the market is going down. I don't care about what's happened 5 months ago. I don't care about what was happening in 2024. I don't care that this right here was bullish. I only care about what happened in the past month, because at the end of the day, yeah, we're swing trading, but we're not position trading for months and months and months. So ultimately, we have a bearish trend right here that I'm gonna mark in red. Boom. Bearish trend, bearish 4 weekly candles in a row. That gives us our direction, which is clearly to the downside. Once we've established that, we can move on to the next step, which is to go down into the daily time frame and just confirm that we see the same type of things. So most of the time you're gonna see the same type of things because the daily is heavily correlated with the weekly, and all the time frames are just put together to make one cohesive trend. Just to make sure though, on the daily we also have a bearish trend. It's also showing us the same thing. If we wanna be more specific, we can start to mark our lows and our highs at this point. So these are the structure points in the market. That's what it's called. It's called the structure point. So as you see right now, I'm marking our major structure points in the market, and you notice how every single high is lower than the previous one and every single low is lower than the previous one. So that gives us a very clear trend to the downside. And if you even want to fill this in, you could do it like this, boom, 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 consistently going down. So once you have that, then all of a sudden we have a bunch of information as to where the market's going to go. It's going down. It's most likely going to continue to go down unless we have a specific sign that it's going to go bullish. Now, this trade, I took it a couple of days ago, actually like a week ago. So obviously now the market has already moved. So let me just go ahead and put back the drawings. All right, so now that we have the drawings, we can see clearly what I saw here in order to take this trade. But first of all, what are the procedures that we go about in order to start looking for setups? So I like having a bunch of confluences that tells me the same type of thing. Number one, the structure points have to be consistently going down. In this case, we see that the trend is downwards. The structure points are pointing downwards. Each single major high is lower than the previous one. That's the first thing. Second of all, I like it when the market is trading below the moving average if I'm looking to sell. It's very simple, but the moving average is an objective indicator of the trend. So if you're trading below the 50 moving average, then it's most likely going to be a trend following trade. And you're actually in a strong moving market, which you always want to look for. Now on the 4-hour time frame, we'll see that price broke down below this area right here. This area right here is an area of support that then is going to be held as resistance. Price broke below here, came back up and retested it. It gave us some good entry confirmations with 4-hour rejections, so 4-hour time frame rejections. But if we go down into the 1-hour time frame, we'll see we actually had an engulfing candle. So this candle right here is engulfing because it's bigger than the previous one. And it's also a nice rejection off of the 1-hour moving average as well. So very, very clear indications. I set up my sell limit right after I saw that and this candle combined. I was like, okay, perfect. Place a sell limit about 10 pips above price, give or take. We're gonna get in, obviously, because the market has to retrace and tap into this moving average one more time. And then the market's gonna probably go down. So it's very, very simple the way I entered in. You might look at the sell limit and say, oh, well, why are you gonna enter in off a sell limit without confirmation? That's because the confirmation was already there in the previous 2 1-hour candles. So that's a very simple idea. Now let's go through all of our confluences for this trade. So first of all, we have a moving average in order to make the market go down. So like you're using it as an objective indication of the trend. You have your support and resistance areas. You have your lower lows. So that's basically the structure points in the market going down. And now let's get into some more technical stuff about my strategy, which a lot of people don't know. A lot of people think it's very simple. You just trade with the trend. but there's actually a lot more intricacies that go into it. And that's what we're about to get into right now. So that way you guys can also take the same type of trades. Okay, so let's actually go into more detail because I noticed in some of my previous videos, I haven't been explaining the actual, things that I look for. And, it's hard to think about. It's hard to remember sometimes because they're so ingrained in the way that I view the markets. But let's go ahead and actually plan it out. So first of all, one of the things here that you see is an M pattern. So an M pattern in the market is a very good pattern. When you see that, it's most likely going to go down. And I've noticed that a lot of the times, at least 50 to 70% of the time after it does go down and breaks the bottom of the M, it's actually going to retest it. And that's what happened here. So I identified this M pattern and I knew this was a good sign that a potential trade was coming up. So let me draw the M pattern here so you guys can see. Let's just say the market has been bearish, whatever. Okay, then we find the support. This is where the M pattern sets up. So it literally just forms an M. And then that's when the market tends to break, come back up, retest it, and then continue to go downwards. This is an area of support right here. This is an area of resistance at the top of the M. And this is the actual M itself. This one marked in yellow is the M pattern. This is a really good pattern that I like to see in the markets. And your eyes are going to get used to it as you start to see these type of patterns more and more. Another thing that I want you guys to realize is the size of the bearish candles compared to the size of the bullish candles. So for example, the market made 3 super large bearish candles to the downside right here. So it did that, and then it formed one small little weak bullish candle to the upside. When you see that and you ask someone, okay, you see these 3 red candles, even if they don't know anything about trading, you can just show this to anyone and say, which color is winning? Is it the red color or the green color? Obviously, the red color is winning because there's just so much more of those candles than there is of the bullish candle. These things seem obvious, but they're super, super important. And it can make you avoid taking a losing position. Like one of my students, he took a losing position. I analyzed it and I immediately recognized, the reason why you lost that trade, it's not because of any mystery. It's not because of anything particular that happened. It's not because your entry was shit. It's because the bullish candles were so strong and he was trying to sell off of one bearish engulfing candlestick. It doesn't matter if you have a big bearish candlestick and you're gonna sell if all the previous candles were bullish and had super strong momentum. So the size of the candles matter. If you have a lot of red candles and then one green candle, don't buy the market. Buying here would have been a very stupid thing to do because the market is still extremely bearish. And that's one of the main hints that you can also use here to literally just improve your entry point and just tells you, okay, the market's probably going to continue down. So another thing that I don't usually talk about, but is another great confluence that you can use is a Fibonacci tool, but specifically you're looking for a 50% retracement. I found that most of my winning trades had about a 50% retracement before continuing in the overall trend. If I draw my Fibonacci right here, as you see, I have my 0.5. Let me make this as dark as possible. I have my 0.5 marked up clearly. I don't have any other zones next to my 0.5. You know how usually the Fibonacci comes with a 0.38, 0.61. I delete those and I only keep my 0.5 because my 0.5 is the main area where price is going to retrace before continuing in a trend. And as you see in this trade, that's exactly what happened. So there is yet another confluence to enter this trade. And as you start stacking these confluences, you just end up having an A+ setup that you feel comfortable risking $6,000, $10,000, $15,000. It's frustrating because on this trade, I actually only risked about $3,000, which is nothing. There was no particular reason for that. On my newer trades though, now I'm risking like $6,000, $7,000, $8,000. Literally, actually the reason for that is just because I've been saving some risk. I was saving risk because I thought I was going to take an intraday setup that same day, but I ended up not taking it. So I could have just used all that risk and put it into this one setup, which was a much better setup. So anyways, so my new trades, I'm risking like 6,000. I'm gonna start risking 10,000 plus because I have a goal of hitting $1 million in profit. and I want to try to hit it this year. And the only way that's going to happen is if I increase my risk massively. I have to start becoming a lot more aggressive in these markets, especially with my 5 years of experience at this point. I believe it's a very, very doable and feasible goal to hit. Those are some of the main things that I was looking for, but there's actually a little bit more if you really look into the details of this trade right here. First of all, as the market was trying to come up here towards this high, notice how it failed to break above the high. If the market would have broken this structure point right here to the left and made a new structure point that was higher than this one, that would have been a very, very bad sign to sell, and I wouldn't have taken this sell position if that would have happened. So these are key points right here. You can't let a structure point be broken in a bullish manner if you're looking to sell. It's very simple. How are you going to have a higher high get formed if you're looking to sell? But a lot of people, they'll see this higher high being formed. Let's say it actually does form up here, and they'll still take the trade because they see other aspects that are good. No, you can't take that trade if it makes a higher high. Don't ever take a sell if the market makes a higher high. That's pretty textbook, and that's something else that this trade had right here. So all of a sudden you start combining all of these things, and it makes the perfect trade. You just have to actually know what to look for. So you got the 50% Fibonacci. You got the fact that on the 4-hour time frame, you have 3 massive bearish candles and 1 small bullish candle right here. You have the structure points going downwards. You have the moving average in your favor. You have an area of super strong support. Notice how this support was held a bunch of times, like 10 times. Then price finally breaks the support, comes back up into it. Of course, it's probably going to reject. You have an entry confirmation. You have 1-hour candles pointing downwards off of your entry. That's already like 7 confluences I've listed so far. And then on top of that, then where do you place your stop loss? Well, you place your stop loss. That depends on the setup itself. On this setup right here, very simple. Let me just remove some stuff from the chart. On this case, I decided to place my stop loss not above these highs because that was way too high and the risk to reward would have not made sense. So I decided to place my stop loss above the moving average with a nice margin of error, just in case the market decided to come back up one more time, tap into the moving average and reject. For my take profit level, first of all, I'm looking for at least a 1 to 2.5 risk to reward ratio. But most importantly, I'm looking to place my support or resistance at the take profit, or my take profit at the support or resistance. Very simple. In this case, I could have held it and made even more. I could have caught 280 pips on this, but I was happy with my 230 pips, and I still caught a very, very big chunk of the market right there. So there you guys have it. If you guys align all of these confluences at the same time, I'm telling you, the chances of you winning the trade is going to be very, very high. The key thing is here, remembering all of these confluences, knowing when to apply them, knowing what to look for. That's going to come with experience. But just use these confluences that I taught you in this video, and you're probably going to see an immediate improvement in your trading results. If you haven't gone that deep into the trades that you're taking, then that's a clear sign that you're not actually doing your homework before entering in a trade. Make sure you have a bunch of reasons for entering, and you're not just entering a trade that looks good and you think is good. No, make sure you're actually entering because you have a whole list of confluences and a whole list of reasons like this to enter in a trade. So that's your strategy, and I'll see you in the next video. Let me know in the comments what you want to see next, and make sure to watch this next video right here.